Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down the global outlook for stocks as HSBC downgrades U.S. equities. Max Kettner joins us on his call on where to find safety. Plus, we'll bring you the latest on trade as China retaliates against the U.S. and businesses sue to halt Trump's tariffs. And Johnson & Johnson out with earnings results. We'll break down the numbers and how a trade war could impact the pharmaceutical sector later this hour on Catalysts. Half an hour into the start of your trading day, let's get you a check on the markets. Taking a look at the major averages. First off, we've got green on the screen again. Could we be in store for a third day of gains? The first three-day stretch since April 2nd, that so-called Liberation Day, according to the president. Perhaps if we continue to see this buying going on. You've got your S&P 500 up about 0.5%. Your tech-heavy NASDAQ carrying most of the gains up about 0.6%. No surprise to see financials leading the S&P 500 this morning off the back of those big bank earnings. All of the banks maintaining their forward guidance and having record-breaking trading revenue. Will that be enough to continue today's trade to be moving to the upside? We'll continue to bring you those moves. But I do want to get over to the bond market, which has been the star of the show as of late and seen some interesting movement. We've got yields continuing to move to the upside just a touch. We did see a little bit more of a sell-off earlier in the pre-market, that calming down just a bit. You've got your 10-year barely moving to the upside, and you've got your 30-year yield up just about 2 basis points, but seeing more of that movement to the upside in yields at the longer end of the curve. The front end still under just a bit of pressure when it comes to that 5-year yield here, and we're going to continue to cover those market moves for you throughout our trading day. But I do want to bring in John Hilsenrath. He is a senior advisor at StoneX and a visiting scholar at Duke University. He also spent 26 years as a writer and editor at the Wall Street Journal. He is our guest host for the hour. I'll be asking you questions. You'll be asking our guest questions. John, we're very excited
a lot to talk about,
to have your insights because there's plenty to talk about. And I want to start where I just ended on the bond market because there was so much volatility in the bond market, a question about whether U.S. debt was still the safe haven asset for investors. What are your sources telling you about where the bond market stands today and if there's more volatility to come?
Well, a couple of things. One is there was also a lot of talk last week about this idea that hedge funds were unwinding basis trades. And inside the Fed, there was some worry that this could become a disorderly event, like in March of 2020 or September of 2019, when the Fed had to get involved. It looks like one of the pieces of good news this week is it looks like that is settling down, that these worries about hedge fund trades unwind are kind of stepping back, and we're seeing more. That
wasn't the primary driver also, right?
It wasn't the primary driver, but I think some of the longer run drivers that have me worried about the bond market are still there. The most important of which is that we're running federal budget deficits this year that are rising 7 or 8% from a year ago.
Yeah.
And Congress, as we speak, is laying out budget plans that have the potential to move us from $2 trillion annual budget deficits towards $3 trillion. So that, I think, is a weight on the long end of the bond market. We also have a lot of uncertainty about what's happening with inflation. And there's this question of whether foreign investors want to continue to buy U.S. dollar assets. So I think there's a lot of uncertainty hanging over that market, and that this hasn't played out yet.
Yeah, and it's interesting because we may not know if that foreign selling is happening for a bit because there tends to be about a month of lag time in the bond market in terms of where you can see that activity.
Yeah. Well, but the proof is in the price, right? So,
right.
And
but is it
it's already
selling,
moved up.
Or is it, investors selling what they have, not what they want to sell, and getting out of U.S. bonds in order to have some cash at their disposal to be able to deploy in this market?
I see you have Scott Besson coming on later today, and I'll be tuning in to hear what he has to say about this, because there are also interesting questions about how the Treasury manages its own issuance cycle. So when Janet Yellen was the Treasury Secretary, they cut back a little bit on long-term issuance and moved towards short-term issuance. He was very critical of that. The Treasury now has a big incentive to do exactly that because there's a lot of demand for safe, secure, short-term assets in the marketplace and some questions about the Treasury as a long-term investment. So load up where the market, meet the market where it wants to be. We'll have to see what he has to say about that.
It's fascinating because he's already recently changed his tune on that a bit and said that, okay, well, maybe we would be okay with stepping in with some issuance. To your point, it was very critical of Yellen doing that. So it'll be interesting to see.
The other really interesting issue for me on the bond market is what we're seeing with stock and bond correlations, right? So over the last 20 plus years, usually when the stock market was rallying, it's because we saw signs of growth in the economy, and that might be negative for bonds. Now we're seeing positive stock and bond correlation. So it's interesting, when we see up days in the stock market, we're also seeing up days for the US Treasury bond. That's the kind of thing you get in an environment that's more inflationary, which is exactly what we are right now.
One of the big questions, and one of many questions that I'm sure our executive editor Brian Sozzi will be asking Treasury Secretary Scott Bessent about. A programming note here, as John just mentioned, at 4 p.m. Eastern time today, tune into Yahoo Finance for an exclusive interview with U.S. Treasury Secretary Scott Bessent. That's coming up later this afternoon. Well, HSBC downgraded U.S. stocks to sell ahead of President Trump's April 2nd Liberation Day announcement. Since then, a slew of U-turns on trade policy have provided some relief for the market, especially among supposedly exempt categories like tech. As policy continues to rapidly shift, where can investors be hiding out? Joining us with more, Max Kettner, HSBC's Chief Multi-Asset Strategist. Max, always a pleasure to speak with you. I know that you remain cautious and skeptical on risk assets, especially in the U.S., but we continue to see some days of movement to the upside like we're seeing this morning with stocks. Is the market sufficiently pricing in your concerns in terms of U.S. equities at this point?
Yeah, good morning, and thanks for having me. Look, I don't think so. When we look at the average stock, look at the equal weighted S&P, in fact, what we're seeing is we're not even down 7%. When you look at particularly, for example, some of the more economically sensitive sectors like consumer discretionary, you look at the equal weighted consumer discretionary sector, it's down barely 10%. None of that really screams big recession fear. I think what we are seeing right now is sort of the market clinging on to every possible positive news in terms of the tariff, the tariff campaign from President Trump. I'm not particularly sure whether the market really has got it right there, to be perfectly honest, because all these flip-floppings, all the U-turns that we're seeing, certainly that is not the environment where now in the Q1 reporting season, where corporates, CEOs, CFOs will really be full of confidence and will be very happy to provide guidance for the rest of the year, let alone guidance that might be even better than we thought. So, I think that the worry I have, particularly for the next 2-3 weeks, is that it's not only the broader equity market, but also the bigger companies, the mega caps perhaps, where either we're going to see corporate guidance for the rest of the year being pulled, or maybe even cut quite aggressively in light of all these external headwinds.
What do you make of that guidance so far, Max? All of the big banks coming out with better than expected guidance pretty much across the board. You've got even J&J this morning, and we still don't even know what the pharmaceutical tariff rate is going to be, and maintaining their forward EPS guidance. Can we trust guidance in this environment?
I'm not. Yeah, I would take it with a huge pinch of salt. I think we've seen in some of the banks as well. Last week, for example, JP Morgan, we saw some of the loan loss provisions materially higher, at least relative to our own analysts' expectations. So clearly, I think the market again is clinging on to the positive news, but it's sort of burying the more negative news flow at the moment. I'm not sure how long that will hold. I think what we're in right now is the sort of classic bear market rally stage where sentiment is so clean, and I think that's what we are seeing. We've just looked at our sort of aggregate 20 sentiment and position indicators, and yes, it really has been sending the biggest buyer signal in about 2.5 years. That, of course, rests on the assumption that we have either more policy clarity or at least we don't have more negative news on the policy front, both of which looks really questionable, I think, for the next couple of weeks and months.
So, Max, what are the safe havens in this environment? I know you don't foresee a lot of safety in the U.S. dollar or in U.S. bonds.
Yeah, I mean, you guys were just talking about it, about treasuries and about the US and then the negative equity bond correlation no longer really being present at the moment. So that to us really means, from a safe haven perspective, much more into things like the Japanese yen, right? So you raise some cash. You guys were talking about it before when you raise some cash. So what do? You probably go into things like the Japanese yen. If indeed the sell-off does continue, that typically really benefits things like the Japanese yen, maybe even like the Swiss franc. But I would really say globally, it's probably a bit more the Japanese yen as US yields, even if they come down, fine. Maybe it's then recession fears if they come down, but it's very US centric recession fears. Is that good for the dollar? Not really. If yields go up, maybe because of either debt sustainability concerns or because of concerns around stagflation. Again, both of which would really not be positive for the dollar, let alone for the long end. So it is much more Japanese yen, I would say, also under the scenarios of debt sustainability concerns or concerns around stagflation. Indeed, even if it was full-blown recession concerns, it's probably much more gold where you want to be in rather than really long end treasuries, because in two of those three scenarios, clearly gold winning out. In one of them, in the recession scenario, probably gold performing sort of in line with US rates. So I'd much rather be buying gold still at these levels. Yeah.
Still buying gold even at these levels. Max, I do want to bring in John. He's got a question for you, Max.
Max, HSBC, global bank, you have big footprint in Asia, big footprint in Europe, Latin America. What is your client base saying to you about its willingness, outside of the US, your client base outside of the US, about its willingness to commit to US dollar investments, treasuries, equities, whatever the case may be?
Yeah, so far we haven't really seen an awful lot in terms of sort of divestments from the US. I think when we look at fund flows, when we look at the broader flow picture as well, right? We look at ETFs and so on. I think overall what we are seeing is more and more enthusiasm, but we've seen that really for the last 2 months, more enthusiasm for Europe, right? For European assets, whether that's on the fixed income side and particularly on the equity side. Think about the infrastructure side of things. Think about the defense side of things. So those names really benefiting. It's also, I think, China. Since the start of the year, we've completely forgot about things like DeepSeek. That's not even been talked about anymore. I think when we look at Chinese internet names, look at HS Tech correcting to almost flat year to date. Now it's been picking up a bit of steam again. We've seen since the start of the year almost 2/3 of foreign investor flows committing to China internet names alone. So it's really been a pretty focused trade within Chinese equities, within H shares so far year to date. I do think going forward that really has a potential for not just being China internet and China tech, but really a bit more of a broader China rally, as we also face pretty easy comparables with last year. And it could really look a little bit like a cyclical rally in the Chinese economy in the next few months.
I also want to ask you a somewhat philosophical question about this idea about safe havens that we're talking about. I think, investors around the world have been conditioned in the last 25 years to think of the U.S. Dollar as the reserve currency and the U.S. Treasury bill and Treasury bond as the safe haven in times of turmoil. What I'm asking people these days is, does there have to be a safe haven? Is it possible that we live in a world where there just isn't one single safe haven? And how does that change the investment game if that's the case?
I think it's tough from a structural basis, I think, really to be uber bearish and call it absolutely the end of US exceptionalism. That is not only because of the shape of where the US right now is, perhaps because of higher political and policy uncertainty, but it's really also the size, the depth, the liquidity of the US market. Think about US treasuries alone. We're talking about almost 29 trillion of marketable treasuries. You look at bunds, you look at German bunds, that's 1.5 trillion. So even if you're saying it's just 10% of 10% of selling of US treasuries, well, that's almost twice as much as there's bunds. So, I think there's a limit to how much we can really play the end of US exceptionalism. I think it's a cyclical story, but it might well really hit a wall in the next few months. And I do think, from a safe haven perspective, yes, we do need that. And I think the market very clearly is playing that, right? Look at gold, for example, since the start of the year, very clearly playing that. Look at the Japanese yen now in the last two weeks. We kind of need that, that sort sort of place where we hide out, at least temporarily, in the periods where, VIX blows up to 30, 40, 50. It's not something where I'm saying, I think the dollar and US treasuries were not a pure hedge, but really diversification. So think about the 60-40 portfolio, where you would plug in the dollar and US treasuries unhedged as a foreign investor, and it would sort of do its thing. It provides some coupon, it provides some income, and in times of turmoil, it also hedges. It's got both characteristics. Whereas really, I think what we're talking about now is more pure hedging, pure asset classes really for those kinds of periods of turmoil, rather than hedge and diversification instrument in one.
Max, I can't help but feel it's very American of us to feel like there are no safe havens left just because the bond market and the US dollar are having a little bit of volatility. Where do you see the most safety in emerging markets outside of the US?
Yeah, look, in fact, when you look at emerging markets, look at local rates. It's astonishing. When we look at the 2010s, for example, in the 2010s, we would have thought, okay, where's the spillovers? What's the next emerging market that is going to be hurt? Remember, we had the fragile five in 2013, and now you look at an EM local rate, you look at EM local debt over the last month and a half, it's actually up 2%. A lot of that, of course, is FX. But, EM debt has actually been pretty stable. I would say on the EM local debt side, there's countries like India paying you 6.5% on the long end. That looks really attractive. Also places like Mexico, even Mexico, we get almost 5.5% real rates on the long end, really attractive there. So there are places to hide out, even I think in some of the more higher beta names, I think, in emerging markets. And from an equity perspective, clearly, I think China, particularly also from a diversification perspective, I think really there is some potential for the rally to broaden out away from playing only DeepSeek and AI broadening, away from that, and also going a bit more into playing a little bit of a mini cyclical recovery in China.
All right, Max, always amazing perspective. Thank you so much for joining us. Really appreciate it. And John Hilsenrath is going to stick with me here on set as well. It's now time for some of today's trending tickers. Today we're watching Palantir, Caterpillar, and HPE. First up, Palantir rising after NATO finalized the purchase of the company's AI military system. NATO says it's completed an acquisition of Palantir's Maven smart system at the end of March. The Maven system uses AI to collect and analyze large amounts of data to modernize warfighting capabilities. Next up, Caterpillar announcing CEO Jim Umpleby will step down at the end of the month. Chief Operating Officer Joe Creed will take over the role effective on May 1st. Caterpillar set to report its first quarter results later this month. And finally, we are watching HPE. Activist investor Elliott Management reportedly taking a stake worth more than $1.5 billion. According to Bloomberg, Elliott plans to engage with the software company to help it boost its value moving forward here. And those are your trending tickers for the day. Coming up, Boeing is reportedly the last company caught in the crossfire amid an escalating U.S.-China trade war. We'll discuss the latest next. Boeing caught in the middle of the ongoing tit-for-tat between the U.S. and China as the trade war continues. Beijing ordering its airlines to halt orders for Boeing jets and any aircraft-related equipment and parts. That's according to reporting from Bloomberg News. Joining us now with more, Monica Guerra, Morgan Stanley Wealth Management Head of U.S. Policy. And Monica, just as we are talking here, a headline crossing, the EU expecting U.S. tariffs to remain as talks make little progress. And you can see the stock market flipping into the red off the back of that after being up throughout the morning here. Where do you see these negotiations heading? Do you have hope that these negotiations will end in better than expected tariffs on a country-by-country basis?
So I think it's anyone's guess at this point, and this is just proof of that. We've been talking a lot about continued market volatility. So even though we received some positive, some upside on the 90-day pause, we've been cautioning investors that it could change at any second. Now, what's important about that is that we want to focus on what is coming from Trump, not what's coming from his administration or his advisors, because we're getting a lot of mixed messaging there, and that's adding to the volatility. So we'll see what happens with the EU. We still don't have a final word on that, but if it looks like it's slow going, they still have that 90-day window, right, to essentially work through these negotiations. It's still early days if you're thinking about that time period.
And let's stick to China specifically, because obviously they are taking a company approach with this Boeing news from first reported by Bloomberg here. Do you anticipate that being a tool for China moving forward, that instead of ratcheting up these triple-digit tariffs that start to kind of lose their punch after they get to a certain point, that they'll start having these kind of company-by-company specific punches at the U.S.?
Yeah, anything's on the table, as we can see. And I know I said that in reference just to the negotiations, but also with what we're going to expect from other countries. The other thing that we're watching is, could there actually be coalitions of nations coming together to ban with a consistent tariff front or a new non-tariff related trade policy? So this could ratchet things up from a U.S. perspective, but also really emphasizes the need for the U.S. to still be an importer. Because even though we're having higher tariffs, right, and we're incrementally raising them, we have to continue that import-export relationship. We don't have a reindustrialized country yet, right? Yeah. So if we're trying to reshore and onshore, that hasn't happened, and I think this is China proving that point.
Well, and then the other thing we're seeing now is the Chinese cutting back on exports of raw earth materials and critical materials in the semiconductor supply chain, auto supply chain, which really, one of the things that we learned during periods like COVID, and even when there was an earthquake in Japan a decade ago, which hit the semiconductor supply chain, is if you hit specific parts of the chain, you could do a lot of damage. I think one of the big next events is President Trump and President Xi start talking. So if we get that headline, how do you think the market proceeds on that? Is that just another piece of volatility, or is that something that could turn this whole cycle?
Another piece of volatility, especially since, if I'm going to bring it back to your semiconductor comment, we are undergoing a study, not just on supply chain, but production, inputs, rare minerals, and we're looking at essentially implementing a VAT-like tax on semiconductors that could ultimately increase the cost of smartphones and electronics. So even though we got a reprieve there's all of these nuances that are going to shake out. So yes, a conversation with Xi, I think, would be viewed as positive because we haven't come to the table yet. But that doesn't mean that there isn't all of this work happening in the background that could still have important implications for the U.S. consumer.
And how likely do you think that is, given that President Trump's tactic here has been asking for a phone call that he has not gotten at this point? Like, how likely are these talks to happen? What is it that could potentially make these talks happen?
I don't have the insight into that. I wish I did, because then we'd be the first out, with a formal view on the direction of that negotiation. But for us, what we want to watch as we head up to that is, how far does the U.S. pull back? I think that could be an indicator. So not just the ramping up of tariffs, like you were saying. At some point, they sort of lose their punch. Mm-hmm. It's, do we start to really make inroads with Mexico on rare minerals? Do we fully decouple in a way that's meaningful, where we hit back from those non-tariff related trade concessions? Mm-hmm. That could get both players to the table, and we're starting to see that non-tariff piece become the critical moment here with China.
I also think this earnings season and next earnings season is really important, because we have to hear from CEOs how they're responding to all of this uncertainty. My guess is the first step is freeze. You slow down hiring, you slow down investing until the coast is clear. But the shoe that I worry that's going to drop next is, if they see consumer spending, if they see a hit to demand, do they start laying off workers? And then we get the dynamics of recession.
And those businesses, by the way, just to mention some news here, small businesses now suing to block these tariffs as well. So I'm curious, from your perspective, Monica, where does that leave small businesses from here? And are they going to have any success? Because they don't have the power that a Walmart has to negotiate with this administration on supply chains.
Well, if you get a big enough, mass, right, and people come together in a single lawsuit, that could change the dynamic, right? You get more power there. You don't just have to be a Walmart, right? There's many ways to get legal action through the system. Mm-hmm. What's important there is that they're challenging the way that these tariffs have been implemented. Now, since the 70s, really aggressively, Congress has turned over the keys on presidential powers with tariffs. The question is, are these illegal? Do they actually fall under the different codes in the actual tariff code, like Section 232 or others, and can they actually move the needle? So we don't have the answer on that yet, but there seems to be some cracks in the administration's argument, otherwise these small businesses wouldn't have had a case, right? So I do think that this is going to be really interesting, really dynamic. Doesn't mean they're going to win, but it is going to shine the light on the possibility that maybe the tariffs aren't explicitly line itemed in the way that they should be.
There's also hope that corporate tax cuts will be continued and potentially extended. But an interesting stat from this morning's Bank of America fund manager survey, over 60% don't have faith in TCJA as the next big catalyst for the stock market. How are you thinking about those tax cuts and whether or not that's going to be the policy dessert that investors have been waiting for? That's
a great question. So with TCJA and the tax cuts, they're pretty much priced in, right? This is the known. As a consumer, you're not getting anything really new unless you get some, wiggle room with SALT and other areas. No tax on overtime, no tax on Social Security. The risk here, I would say more than the benefit, is to that corporate income tax, the top line income tax. So they're talking about lowering it 6%, which is a huge cut for corporates. And if they don't get that, then it's essentially an opportunity to disappoint markets. Now, where you could see, I would say, some positive action and a relief rally, don't think it would last long, but you'll get some relief in response to a passage of a bill, is that the tariffs are actually being earmarked as a pay-for those revenue losses, right, from the tax cuts. And so even though there's going to be negotiations on the margins, we're going to still see things hammered out with Europe. We're still going to see a back and forth with China. The core tariff framework is going to need to be set for the CBO, the Congressional Budget Office, to score that and actually allow the Congress to pass the bill. So that creates a certain level of certainty. While it's not perfect clarity, it creates a certain level of certainty for investors to get off the sidelines. They understand their tax framework. They understand basic tariff 101, if you will, and then we can put money to work from there.
If I could follow on to that, I think it's a critically important point, and it relates to what's different between now and 2017, 2018, the president's first term. In 2017, the story was a large corporate tax cut. There were tax cuts for individual income tax rates, but it was really the corporate tax rate that went from 35 to 21%, which was totally reset. Yeah. It's hard, as you just said. It's hard, you're not gonna cut that another 15 percentage points, right? So you're not gonna get that kind of tailwind to the economy and corporate profits. The problem, if you go to 15%, as some people are talking about, is you now have a budget deficit that's $2 trillion and heading towards $3 trillion. And in terms of taking the tariff money and using it to pay for a corporate tax cut, if you do that, you're not putting it towards reducing the deficit. You also have individual income tax giveaways that you're talking about doing. I think what we're seeing in Congress right now, what we saw over the last few weeks, was they're throwing away the idea of deficit reduction. Yeah. And this links all the way back to the bond market. What we're seeing in the bond market is people saying, well, wait a second, that's not going to work. And so the risk for Congress is they advance a plan that doesn't do anything on the deficit, and then you get higher interest rates. And the pieces of the puzzle don't fit together.
They certainly don't. And right now, you're continuing to see yields moving to the upside off the back of some of these tariff headlines as well, to your point, John. So thank you so much. John Hilsenrath going to stick with me for the rest of the hour. And a huge thanks to Monica Guerra for joining us as well. Great breakdown. Really appreciate you always. Coming up, what Johnson & Johnson had to say about levies in its latest quarter as the pharmaceutical industry braces for more tariffs to come. That's next. Johnson & Johnson topped the street's expectations in its latest quarter thanks to strong cancer drug sales during the 3-month period. The company boosted its full-year sales outlook, but tempered expectations for its adjusted operational profit, citing the impact of a recent acquisition and, of course, tariffs. President Trump has warned that levies will be placed on the sector very soon. Joining us now to discuss, Asad Haider, Goldman Sachs Global Investment Research Head of the Healthcare Business Unit. Asad, great to speak with you. Let's start on Johnson & Johnson maintaining the EPS outlook. How were they able to do that in your view, and what are your other big takeaways?
Yeah, thanks for having me. So there were some questions. I mean, overall, we thought that the quarter was actually very encouraging and very much in line with the thesis that we have on Johnson & Johnson. And just to zoom out for a second, we upgraded the stock to buy last week based on our view that the innovative medicine business is going to continue to surprise on the upside and show encouraging trends. And that's really what you saw. Now, there was some gross margin related pressure, which they cited, they attributed to Part D dynamics. This is the first quarter that the pharma industry is going to see some headwinds from the Inflation Reduction Act, particularly related to Part D. And there were also some tariff related costs that they talked about $400 million that they attributed to the medtech business. But beneath the hood, the pharma business did really well, and their operating margins actually beat because they flexed the P&L via cutting costs and cutting R&D. And to us, that was actually a very encouraging sign. And I think the combination of those things, along with a little bit of an FX tailwind, had them maintain the earnings for the year.
And how are you thinking about the impact of tariffs both on Johnson & Johnson and then just moving forward, because they are the first pharma name to report? What does what did their results tell you about how the rest of the industry might be impacted by tariffs as well?
Well, the short answer is not much. And I think it's still all very uncertain. I think we all have been waiting to see what the announcement for tariffs is. I think what's known, of course, is that the pharmaceutical industry is going to be tariffed the way semiconductors and autos and several other industries are. We've been waiting for this for a while. What we also know is that there has already been a Section 232 investigation that has begun. And depending on how that goes, what we're all going to be waiting for is to see what level of tariffs are going to be applied to the industry. And at this point, I just don't think we have a lot of clarity on any of that. And so what that's been doing is creating a lot of uncertainty across the entire pharmaceutical sector. It's making people question the traditional orthodoxy around the margin structure and the profitability of this sector. But we just don't know a lot right now. And I think it would be too early for me to speculate on where this all lands. But this is a cloud that the sector, that it's an overhang on the sector. And until we get a real off ramp, it's going to be hard to see how that, how that overhang goes away.
And Assad, my guest host, John Hilsenrath, is still with me. John, you got a question for Assad?
Assad, you talk about J&J flexing their earnings muscle by cutting cost and cutting R&D. I'm listening to hear how all of this affects the economy, and that sounds like bad news to me.
Well, I don't think it's bad news necessarily. I mean, I think we don't really know line items on what exactly they did on the SG&A and the R&D side. I think it just speaks a little bit to the leverage that they have across the P&L to make these types of investments. I think what's more interesting is just the way that Johnson & Johnson has been responding, as I expect others to these tariff threats, which is building infrastructure, manufacturing facilities in the U.S. I think everyone saw that about 3 weeks ago, they announced a $55 billion manufacturing commitment to the U.S. That is higher. That's about 25% higher than what they had initially said they'd do. They opened a new facility in North Carolina, which they are going to use to manufacture in the U.S. And there's 3 other facilities that they're going to bring on the manufacturing side that are yet to come. So I think those types of measures are probably more important for as far as the overall economy goes than these pharma companies really flexing the P&L in there with things like SG&A and R&D.
Yeah, Assad, I'm also curious how you're thinking about the impact of China and any China demand on this. John, I wonder if you have a question to that end as well.
Well, I'm interested in China, and I'm also interested in the risk that they cut off supply chains and that affects the supply chain of the pharma industry.
I mean, John, I just don't think we know. I just think it's just too early to speculate how this all plays out. Like I said, we are right now navigating a period in the pharmaceutical sector where there are just a lot more questions than there are answers. I think it would be too premature for me to speculate on what gets tariffed, what happens with China, what happens with demand. But our focus is just on fundamentals, and our call on J&J really has to do with the fact that their pharma business and some of the new product cycles within their pharma business are actually underappreciated based on some of the diligence that we've done. And once this blows through, I mean, that's really where we'd be guiding investors.
All right, Assad, thank you so much. Really appreciate it. John Hilsenrath is going to stick with me for the rest of the hour. For our audience, we're going to continue to have all your markets action ahead, so stick around. We're watching Catalysts.
The S&P 500 printed its first death cross in 3 years on Monday. What is this trend? What does it mean for your returns? I'm Jared Blickery, host of Stocks in Translation. Let's get to a few definitions first, and I'm going to start with the moving average. We got to know that. It's very simple. It shows the average price over a set time, like 50 or 200 days, and it updates as new days come in. So basically, it's the last 200 days closing prices. Now we can move on to the actual death cross. This is when a short-term moving average, like the 50-day, falls below a longer-term one, such as a 200-day. And I'll show an example later on, but I first want to run through some of the statistics here. This is what happens next after you get a death cross in the S&P 500, 1 day later, 1 week later, 1 month, 1 quarter, and 1 year. And this is the median results going all the way back to 1961. And there were 32 instances, which is not nothing. So we do have a decent sample size here. And I also have the percent positive returns. So you'll see, for instance, on the first day, 1 day after, we might expect a slightly negative return on balance, and then a 47% positivity rate. Now, because stocks go up most of the time, you actually need to see something over 70 to be bullish, and you just need to be under 70 to be a little bit bearish. And so this definitely qualifies as a bit bearish. You can see 1 week out, we still have average or median returns that are positive. In fact, they're positive all the way going up to 1 year. Why would this be? Well, sometimes you get a very fast decline like what we had in the pandemic, and by the time you get that signal, the market is just rocketing up and you've already had the bottom. Whereas other times, like the global financial crisis or even in 2022, the market will take its time going down. And so when you have that death cross, it's actually a good signal to get a little bit more bearish. Now, these stats go back to 1961. I also have them going back to 1990, and they're a little bit less bad. But I think what we want to take away from this is that the death cross itself is not really a great trading signal. You need some other confirmation or rejection. And I'm going to close here by just looking at an example in the S&P 500. We do have the native capability to show moving averages in the Wi-Fi Interactive. And there you go. We did get that death cross yesterday. And I'm just going to show you the last 6 years so you can see that 2022 example happened somewhere in there, and we got a decent decline off of that. Whereas in 2020, we got it very close to the bottom, and so that might have actually been a buy signal. We can also see in Tesla just printed a very similar chart, very similar pattern. Its death cross activated only yesterday. And individual stocks trade a little bit differently than the indices. They tend to move a little bit quicker. And so if I'm trying to trade Tesla here, I'm looking for a nice break over that 200-day moving average that is sustained. Whereas if I'm looking at the indices like the S&P 500, I want to see a break above, come back down and test it, and then gently rise from there. Tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. Well, Federal Reserve officials offering insight into the central bank's read on the economy this week. Federal Reserve Governor Christopher Waller saying the inflationary impact of President Trump's tariffs will likely be temporary, while still leaving open the possibility for rate cuts to come. Meantime, Federal Reserve Bank of Atlanta President Raphael Bostic saying officials must wait for clarity on the president's policies before adjusting interest rates, saying now is the time to move boldly. Fed Chair Jerome Powell is set to speak at the Economic Club of Chicago tomorrow, but joining me to discuss all of the Fed speak and how it might be related to earnings season, I've still got John Hislenrath here in studio with me. So John, this Fed speak was interesting because Chris Waller kind of expecting inflation to be temporary, but also sort of talking about rate cuts to come and sort of running for Fed Chair Powell's position to come. Right, yeah. You have to take that with a little bit of a grain of salt.
Well, so Waller's a really interesting character because he was ahead of the curve last year and in previous years on kind of seeing where the Fed was going. And I think a number of people in the market started to look to Waller as, some indicator of where Jay Powell was going. Mm-hmm. And he kind of had that, a little bit of that mystique. As you said, how are his motives changing now? When he was appointed by President Trump in his first term, he might have a shot at becoming chairman when Powell's job is up in a year or so. Is Waller now saying what the president wants to hear or what Powell is thinking? It might be some mix of the two. I think what Bostic said today is more the conventional view inside the Fed, which is, and we were just talking about this offset, about being in a wait and see mode. If you're the CEO guiding earnings right now, or if you're the chair of the Fed, when there's so much uncertainty, and Jay Powell said this in his press conference in March, when there's so much uncertainty about where economic policy is going, you don't want to get over your skis and start saying we're guiding down or we're guiding up or we're guiding anything, because you don't know either. And I think the Fed's view right now is let's wait and see how this plays out. My own view is they don't move anything until they see the whites of the eyes of the problem. And they don't know what the problem yet. What the problem is going to be, whether the greater problem is inflation or unemployment. And we might have both moving in the wrong direction over the next few months. So my own view, and there's a market issue here, my own view is that the Fed is in a wait and see mode. The market has been pricing a Fed rate cut in June. That started to shift over the last week, but last week they had a 95% probability of the Fed cutting in June. That's come off a little bit, but we'll hear what Jay Powell has to say. I don't see him moving the ball when he talks tomorrow. And
we'll also hear what a slew of executives have to say as we continue our coverage of earnings season this quarter, and whether or not we hear any concerns about inflation or unemployment there as well, a key indicator. John Hilsenrath is going to stick with me. I also want to give you a programming note. You can tune in at 4 p.m. Eastern time today for a Yahoo Finance exclusive interview with U.S. Treasury Secretary Scott Bessent. That's coming up at 4 p.m. Eastern. The U.S. stock market currently ticking higher, but with the latest whipsaw moves following President Trump's trade policy, our next guest says there are some bearish signals and reasons to look to the value trade. Here with a few of his top picks, we've got Joe Tigay, Rational Equity Fund Portfolio Manager. Joe, it's great to speak with you. I know that the top pick that you've sent over to us is Berkshire. Lay out the bull case for Berkshire for me. Why is there still more room to run?
Yeah, thank you for having me. I'm Joe Tigay, Portfolio Manager, Rational Equity Armor Fund. I'm a former options market maker. I was on the floor of the CBOE trading VIX and S&P 500 options. So times like these are what I really live for, and it's really, really a joy to be able to bring this this type of strategy to light for my clients, providing upside potential with less risk. It's really exciting times. But yeah, Berkshire Hathaway, just in the times like this, just looking at the bond market, specifically the bond market flashing major warning signs of a recession. I want to get defensive just a little bit. I still have a long-term bullish approach on the U.S. economy and the U.S. stocks, but in the short term, next couple quarters, just want to be defensive. Berkshire Hathaway done a great job hoarding cash. We know Warren Buffett's management. We know what he's been able to do over the long haul. There's been some bargains for him to be able to look around, scoop up. He's going to be able to use that cash very effectively as prices go lower, of course. And just looking at domestically, got a very stable portfolio of stocks which are able to weather these types of storms. And while we've seen a pullback in the tech stocks, yes, it was pullback in the growth names. We've also saw a pullback in a lot of the value names. I think those also have room to run higher. Unfortunately, I think it'd be better for the market if the growth names were going to be leading the way. I'm just a little concerned short term if maybe money will be put towards the value names because there's not that growth catalyst that people can see just yet. Now, hopefully that happens. Hopefully it's something that I don't know about happens, either a Fed doing something, maybe a taxes deregulation doing something to spark the market to get to that next level higher. I don't just have my finger on what that is. I'm not aware of what that is. In light of my lack of knowledge of what the next step is, I'd be looking for defensive areas. Berkshire Hathaway is, of course, the top in class.
And sticking with Berkshire, my co-host John Hilsenrath has a question for you.
Yeah, Joe, sticking with Berkshire, besides owning Berkshire, the stock, what lessons can our viewers out there who are watching this take from Warren Buffett, from his style and the way he manages a portfolio to apply to their own portfolios in this kind of environment?
Yeah, so he wasn't paying attention to any of the headlines. He was just kind of looking at some of the charts and trends. He was looking at high PEs versus GDP. That's his index he likes to look at. He was just saying, hey, prices are historically high right now. I'm going to use this opportunity to sell some of my portfolio to gather some cash because he's been at this game for a very long time, a lot longer than I have, of course. And he knows that these things come in cycles and waves. And usually in bull markets, these prices get too high. and in bear markets, they have a tendency to get too low. So he decided to load up his ammunition. He did so previous cycles. It worked very well for him. He sometimes says early, and that's been okay, of course, to do so. He's been, or he was early in the great financial crisis in collecting some cash, hoarding some cash. Ultimately, he proved out to be right because prices, you don't often know the exact time, but you do know when they're expensive. So when they're expensive, he has a tendency to hoard some cash. He then puts that back to work after the downturn.
All right, we got to leave it there. Thank you so much for joining us this morning, Joe. Really appreciate it. Also want to give a big thanks to John Hilsenrath of StoneX for joining me for the hour. Really appreciate getting your insights. Those years of reporting at the Journal always coming in handy for us here when you join us. I do want to take a look at the market before we head out today. You are looking at gains across your major averages, though they have pared their earlier gains to the upside off the back of that announcement of the EU tariff negotiations continuing. That's going to do it for Catalyst. Tune into Yahoo Finance at 4 p.m. Eastern for an exclusive interview with U.S. Treasury Secretary Scott Bessent. Brad Smith has you for the hour. Stay tuned.